Depreciation, and what is it? Well, from an investment property perspective, it's a big coup when it comes to tax deductions. But I'm going to give you a couple of examples of how depreciation works, the difference between a house and land or the difference between an apartment. So we have a house and the land is worth $250 and the build was $250, so it's a $500,000 purchase. Your depreciable amount in that property is $250,000. There will be parts in it that will be called building and there'll be parts in it that's called plant and equipment. Again, your accountant would work out what this is. But then if we bought in an apartment for $500,000, the depreciation part of that $500,000 is most likely $499,000 because the land component may only be worth $1,000. So from a taxation perspective or a tax deduction perspective and an investor's perspective, having an apartment in your portfolio will give you a bigger depreciable asset because of the amount of money that went into constructing that apartment, which is in a complex. From a house and land perspective, it's just on the house component in the build. So it's not to say that you should have one or the other, it's for you to understand that there are options and you need to know how you can maximise the word depreciation being an investment property owner. Of course, rules did change on the 9th of May 2017, and depreciation only is attracted now on new buildings, new builds as a house and land, and new builds as an apartment. So once again, speak to your accountant about this, they will explain it fully, but it is a really great way to get into the property market if you're an investor and use it as a tax deduction. Hope that helped.